Good morning, everyone. This is Marshall Giller bringing you the morning comment for March 24th. We've heard a lot of Fed officials commenting on the dollar and its impact on their outlook. To me, the market seems to be misinterpreting their statements, probably in order to justify profit-taking on long dollar positions. The impression I get from all their comments is that, yes, the dollar may restrain exports, but that was already factored into their forecast for slightly slower growth and won't put them off raising rates. Almost all the comments I've heard from Fed officials still imply that they're considering a rate hike by mid-year. I believe the market is overemphasizing the likely impact of the stronger dollar and drawing the wrong conclusion with regards to policy. I expect a reversal of this approach at some point and, of course, the resumption of the dollar rally. Now, Greek Prime Minister Tsipras met with German Chancellor Merkel and had what appeared to be pleasant talks, but no change in Greece's financial position. A Greek government official said the country may submit a list of reforms by the end of this week. That's none too soon, as there are reports that the country will run out of money by April 8th. So Greece remains a major risk for the euro. Today is PMI day. China and Japan were the first, as usual. China's HSBC market PMI was down sharply and is now back in contractionary territory. This confirms the slowdown in Chinese growth that began to appear in the data during January and February. Now, the Australian dollar is the currency most vulnerable to slowing Chinese growth, and I'd expect Aussie Kiwi to resume its slow grind towards parity. The Japanese manufacturing PMI, which attracts little attention, is now just barely in expansionary territory. Preliminary manufacturing and service sector PMI data for March from several European countries and the Eurozone as a whole are coming out today. The Eurozone PMIs are in a sweet spot. Generally, they're in expansionary territory, and the rate of expansion is accelerating. We could see further improvement this time, too. However, that doesn't do much for the euro, which is dominated by quantitative easing. The U.S. market manufacturing PMI is expected to slow, but still remain well in expansionary territory. On the other hand, Australia and Canada are not only contracting, but contracting at an accelerating pace. These economies are suffering from the fall in commodity prices. I expect their currencies to weaken as a result. From the UK, we get the CPI for February. Inflation is expected to slow to just 0.1% year-on-year, just above deflation. This is far below the Bank of England's target, and to make matters worse, inflation expectations are coming down too. A further decline in inflation could be negative for the pound. In the U.S., the headline CPI rate for February is expected to remain in deflation on a year-on-year basis, but the core CPI rate is expected to accelerate slightly. This suggests that low energy prices are the main reason behind the deflationary pressure. The Fed has said that this is just a transitory effect, and so it's willing to look past it. So the acceleration in core CPI could be dollar positive. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google+ to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.